I'm Robert Weinstein with One Reason. Today, I'm going to discuss if you should have a limited liability company, an LLC or not, from an insurance and liability perspective. I'll talk about what an LLC is and why they're available as an entity type at all, the importance of seeking professional legal guidance, tax treatments and benefits you may not know about, your ability or non-ability of limiting your liability by using an LLC, why insurance is often a better tool than an LLC to limit personal liability for most single-member LLCs, why I think LLCs are a great way to limit your personal liability for many but not for others. My understanding comes from over 30 years of small business experience, along with my almost exclusive work helping small businesses within the world of commercial business insurance and accounting. I often have new or soon-to-be new business owners asking about how to best protect their assets and, of course, shifting, transferring liability exposure and risk to an insurance company. For many business owners, it's a surprise to find an advocate for operating as a sole proprietorship instead of forming an LLC. However, to be clear, I'm only an advocate for what's in my client's best interest. In order to understand why an LLC may or may not make sense, let's first take a look at what an LLC is, so we're clear about that. LLCs are separate entities and are not the same as their owners. Because LLCs are separate from their member owner or owners, you can think of a limited liability company as a person in the legal sense. A legal fiction, granted, albeit limited liability companies can sue other people or businesses, be sued, contract with other businesses and people, and do all sorts of things, including obtaining licenses and even receiving fines from the government, just as real people can. The difference between the two is one is called a natural person, that's you and me, and LLCs are simply called persons within this context. As much as we may attempt to avoid it, a natural person can die, while an LLC can, in theory at least, live to be well past the ripe old age of 200 plus years and doesn't have to necessarily die at any given time, regardless of age. Thus, if you ever wondered why an LLC would ever be considered a person, it's for the sake of separating it from the investor owners and allows the LLC to be its own entity relative to what it can and cannot do, and what can and cannot happen to it. Another obvious difference is an LLC can't actually do anything on its own, so it relies on agents acting on its behalf. Agents are usually officers and or employees, and they're the ones that allow an LLC to function. I'll touch on agents again and why agents normally have simultaneous liability along with an LLC. Before the concept of LLCs, though, the two primary options for a one-man or one-woman band was either operate as a sole proprietor or jump through the hoops to create a corporation. While the initial requirements were daunting to many on their own, the continuous, never-ending corporate formalities and expense turned most people off and away from incorporating. This was problematic, though, because without limiting liability, investors were reluctant to move forward out of fear from the potential of losing literally everything. Thus, LLCs came about out of a desire to have a simple company that can limit liability, hence the name, without all the work and effort demanded of a corporation. surprising to some, LLCs are a relatively new business entity concept that's only been around for maybe 50-ish years. Thus, the original thinking was for a limited liability company to take many of the best and most attractive attributes of two business types. A corporation, which allows for the limiting investor liability through the use of a separate entity others can invest in, and a sole proprietorship, which require very little in the terms of formalities and smashing the two together, resulting in a unique combination. The result of this love child enables investors to begin and continue a business without requiring a great deal of time, effort, money, and knowledge needed to maintain proper corporate structure and its continuous rigid formalities, freeing up the LLC owner to focus on building the business instead. Because LLCs are generally subject to fewer rules and regulations relative to corporations, much greater management flexibility is afforded. In fact, the simplicity of limited liability companies often allow business owners to use default organization rules created by the state, commonly on the state's website when filling out the online forms to organize an LLC entity, with very few changes, if any, in the available variables. Using the state's defaults can save the business owner money by paying a lawyer to set up the business entity. However, I'm not suggesting it's a good idea to avoid the legal cost and advice to do it right the first time. Even if you want or think you want all the state website default choices, I highly recommend spending the appropriate amount of time with a business attorney to discuss the pros and cons of all aspects of business formation. If you don't want to spend or don't have the money to spend on an attorney, you may be in luck. I recommend looking to the local county's bar association and see when they're having a free attorney clinic. If you didn't already know, and many people don't, most county bar associations offer a legal clinic about once per month, and anyone with a legal question or with legal questions can talk to an attorney for usually 15 to 30 minutes about any given issue for free. You're likely to find this legal resource occurring at a library or other similar public venue. A free legal clinic may not be on par with spending a few $100s with an attorney wanting your business. However, if the only choice is no legal advice or a free legal clinic, don't hesitate and take advantage of it. Keep in mind, similar to corporations, management, agents, and controlling members owe a fiduciary duty of care to both to the LLC, it's a separate person within this context, as well as LLC's investors. Often, the investor, manager, and controlling member is all one person, or maybe a husband and wife. As a single member LLC, you're wearing every hat, albeit need to be mindful that your LLC is separate and must be treated as such. Failure to treat your LLC as a separate person can possibly result in losing your personal liability protection. In every state I'm aware of, a single member LLC default tax treatment is to have income pass through to the owner, and that income is considered earned income compared to, for example, investment income. There are 4 possible ways LLCs can be taxed, with 3 ways available to any given LLC, and this is where some planning, especially with a tax professional, can really save you some money in your tax exposure, liability, and cost. The ways to tax, more correctly characterized as its tax treatment in LLC include treating the LLC as a complete pass-through sole proprietorship. Again, that's the default tax treatment for a single owner LLC. LLCs can also be treated as a partnership pass-through entity, which by definition requires more than one owner member, and that's the default tax treatment for a multi-member LLC. However, LLCs have the ability to take advantage of corporate tax treatment also. For example, an LLC can elect to be treated as an S-Corp pass-through entity. For LLCs generating significant profit, shifting from a sole proprietor to a S-Corp for tax purposes can result in significantly greater after-tax income to the member owner or owners. Lastly, an LLC can elect to be treated as a full-fledged C corporation where income doesn't pass through at all. The LLC reports and pays income tax as if it were a C corporation. One potential downside is if the owners want to receive investment income from the LLC, the owners will pay a tax on that income, even though the LLC already paid tax on the same income too. Investors paying tax on income from a business already taxed is commonly referred to as double taxation. In order to take advantage of either S or C corporation tax treatment, the IRS requires the owner or owners to make an affirmative election to receive either an S or C Class C tax treatment. This tax treatment comes from the IRS and doesn't impact the fact that your LLC is an LLC, and it doesn't become a corporation by electing a corporation's tax treatment. It's still an LLC in every other facet other than how the IRS treats the income. Again, an LLC is based and comes from a state, while federal tax rules come from the IRS. An important keynote is each state sets up their requirements, fees, and rules regarding LLCs within the state. So what may be the norm in one state may not even be allowed in another. Therefore, it's important to seek competent professional legal advice when it comes to matters that are legal in nature. As a reminder, my primary purpose here is to speak about LLCs from the context of if they're worth the extra effort and expense as a liability mitigation tool with an attempt to include other really important factors to consider, especially when viewed as an either or, as a replacement for insurance coverage. And even then, the best I can provide is a general across-the-board overview because each state's laws are unique, as well as your specific situation. Okay, so that's what an LLC is. And hopefully my explanation will build a base of understanding as I discuss why, in some cases, you may not want one. Or perhaps if you already have one, it may not offer the amount of liability protection or other qualities you were under the impression having one offers. And again, everything within this decision-making tree is based on relative importance. Because, like many things in life, it's not necessarily black and white, albeit rather many shades of gray. Reason number one of why not to create a single-member LLC. The first easy reason not to organize your business as an LLC is the cost. You should plan on spending money on an attorney, accountant, business consultant, potential publication requirement costs, and or tax consultant if you're starting your business correctly. Granted, regardless of business entity chosen, many of these costs will be there. However, one can expect to spend more to form an LLC versus sticking with a sole proprietorship. In some states, including California, the cost of having an LLC can be easily become much greater than the profit for a starting small business. If you're considering forming an LLC in California, you'll want to confirm, however, I believe California demands $800 per year as the minimum income tax an LLC will owe. I guess California considers $800 as a minimum the cost of having limited liability. In my mind, that's not really fair for several reasons. First of all, when I consider California's $800 minimum income tax on LLCs, I can't help but think it's akin to a protection racket where some guy in a suit comes around a neighborhood and tells the shopkeepers they better pay up to ensure nothing bad happens. In my experience, many state employees think owning a business is a privilege, and charging $800 in income tax, regardless if the LLC made money, appears to support my impression. Albeit that's a bit off topic, and I'll get off my soapbox. Regardless, if the cost is super high or so low it's immaterial, there's a cost in the formation in every state I'm aware of, and I would be very surprised to find any state that doesn't use the formation as a revenue source beyond the state's actual cost to some degree. Forming an LLC increases the amount of accounting required, and this can vary greatly on the tax treatment elected. In fairness, I can't help but recommend every business, regardless of the entity type, have copious accounting standards so the health of the company is known and planning can be properly executed. With that in mind, let's take a look at the requirement differences though. A C corporation treatment will have much more accounting requirements than a sole proprietorship. Often this will require different software to calculate the income and the dividends, especially if you want to pass that through to the members, thereby increasing the maintenance cost. Plus, you may need an accountant where you otherwise could potentially have done it all yourself. The next reason for not forming an LLC is many procedures take more effort. For example, instead of having one or two checking accounts for both your business and personal affairs using your own personal information to open the business account, you will have to set up a totally separate checking account using the LLC information and provide the same to the bank. You can expect the bank to require a hoop jumping in order to open a checking account, plus you'll almost for sure be required to personally guarantee any lines of credit for your LLC, which completely destroys the liability limiting benefit regarding your bank. Again, an LLC must keep its financial dealings separate from the owners. Even single-member LLCs or risk losing the limited liability status. In other words, separate credit and or debit cards, savings, and investments. Next, your LLC may incur greater ongoing legal costs. If your LLC is a party to a lawsuit, regardless if plaintiff or defendant, there's a strong chance you may not represent the LLC in court, and you'll have to hire an attorney to represent the LLC. This limitation alone can become significant because, for example, let's say you have someone file a frivolous lawsuit that's just above the small claims limit, and you know the case doesn't have merit, and you feel the matter is relatively simple and you could handle it yourself. Well, in every state I'm aware of, the LLC will have to be represented by an attorney. That said, in Wisconsin, my state of residence, and California, an LLC can be represented by an LLC officer in small claims. My understanding is many states allow an LLC to be represented by an agent who is either an employee and or owner in small claims, and you're well advised to find your state court's rules. For example, many real estate investors want to limit their liability by placing each property in its own LLC entity. While an eviction in Wisconsin is normally handled in small claims, a suit alleging discrimination may not be. With small claims monetary limits relatively small, hence the name, you could easily find yourself paying a lawyer to appear for your LLC when you may otherwise do so. And it's important to note that just because a case starts out in small claims doesn't mean it will stay in small claims. For example, let's say your LLC is sued in small claims and your LLC wins. You may think all is well and good, and that's the end of the matter. However, the losing party may appeal the judgment and bring the case out of small claims and into circuit court, which, again, requires an attorney. Of course, this LLC negative could save yourself from yourself. In a given situation where you think you can handle the controversy, you may find hiring an attorney saves your bacon because you're unknowingly over your head. If you're in a state that doesn't even allow you to represent your LLC in small claims court, and I welcome you to leave comments advising of any, it can become a significant additional cost, especially for landlords. The next reason why an LLC may not be right for you is potentially the most important one. There's another liability trap for single-member LLCs that appears many people don't fully appreciate. As an agent for the LLC, and in this context, an agent means anyone acting on behalf of the company, LLC, which is much more expansive than a person who is an officer or an employee, is usually personally liable for their own tortious conduct, including negligence absent a state statute stating otherwise. Thus, it's important for you to find out your state statutes and case law for agent liability from a qualified attorney. What I mean is, it's possible, you should really consider it likely, both the LLC and the agent who is personally negligent to another are both liable for the injury caused. In other words, having an LLC isn't a get-out-of-free-jail card. If you personally and negligently cause bodily injury and or property damage to another. There's a few more moving parts here, so let's break it down for simplicity's sake. We'll start out with why a business can be held responsible for the acts of employees. As a society, we've decided a business normally is in a better position to make an injured party whole when an employee negligently injures another. The business is much more likely to have liability insurance and far greater financial resources, typically. A business can spread the cost of risk to many customers too. Also, if a business isn't held liable for the acts of its employees, the business will not have the same motivational level to keep employees in check to avoid injuring people to begin with. This is so commonly known, I find some business people don't know it hasn't always been this way. We call this concept where a business is liable for the acts by employees and agents vicarious liability, or sometimes the doctrine of respondeat superior, which means let the superior answer. On a side note, parents can have vicarious liability for their minor children too, if that helps in the understanding. Going back full circle though, while an employer may have vicarious liability for the acts of its employees, agents, the agent isn't necessarily off the hook just because the LLC has liability. In other words, Let's say you own a single member LLC and you're working on a roof and you drop a hammer off this roof. As the hammer falls, instead of hitting the grass, it hits a child in the head. Not a happy thought, to be sure, but these things do happen. Unless there's a statute limiting the liability to only the LLC and the person who actually dropped the hammer are both liable. Thankfully and hopefully, you're quickly coming to the realization that this dual liability quickly blows up the notion having an LLC is an appropriate replacement for insurance coverage. Using another example I find common with single-member LLCs, if you're making a product in your single-member LLC small business operating out of your home, for example, you're a candle maker and you're selling your candles on the internet, then you can and should count on personally being held responsible for anything that goes wrong regarding negligence, as well as strict liability defects, including design defects, warning defects, and manufacturing defects. And why? Because unless you have non-family employees performing the work, which is unlikely in this fact pattern, you're doing the work yourself and thus could be held personally liable along with your LLC. As you can see, forming an LLC may not offer any real protection against the most significant liability risks possible, even if it could possibly protect against some liability exposures from some creditors. And even if you're not exposed to liability as an agent of the LLC, you may still have personal liability for your LLC's debts if a plaintiff is able to pierce the corporate veil. Piercing veils of an LLC is beyond the scope of this, albeit I'll follow up with more about this legal maneuver and why insurance is your only true protection if this happens. The next reason is you may lose a potential health insurance benefit if you're married. Some health insurance cost saving strategies may not be available to you. I don't want to get too complicated here, and because health insurance rules and laws seem to change on what feels like a daily basis, I'll leave this point as, unless the rules have changed, there's a potential health insurance savings because of tax treatment available to sole proprietorships not available to separate entities for married people. I'm leaving that as a last reason because the ability to take advantage of the tax rules is highly limited and may not even exist at the time you're seeing this. Okay, so that's a lot to think about, and for many, an LLC may not be nearly as attractive as it was before today. However, let's take a look at the positives for a balanced look. This is also a good time for me to mention I'm not against LLCs or other liability limiting strategies. I'm only against those strategies that won't work as expected in a given situation. For many people, and again, this depends on the appropriate state statutes, where the business operates, and the business activities, an LLC is a great way to limit your personal liability. First positive is the most obvious. LLCs have the ability to limit liability, which is painfully clear by now. If you're looking for a non-active investor in your business, this attribute is key to securing investment because of the ability for investors to limit their liability. If you get a loan and don't have a personal guarantee, generally, you're not going to have to worry about personally paying the loan if the LLC isn't able to do so. And by loan, I also mean business trade debt, for example, when a supplier provides payment terms. An LLC can personally protect LLC members against liability caused by the negligence of employees hired. This protection, in my mind, is the most important level of protection by LLCs with employees working. Going back full circle, to the tax treatment, having an LLC is almost surely going to save the owners, investors money on their tax exposure with a profitable business due to the various tax strategies available to an LLC that aren't simply available to sole proprietors. As an LLC makes more money, this becomes increasingly more important. At the time of sale, for example, when the owner wants to retire, having an LLC can make the sale simpler and or more attractive to a potential buyer for many reasons, including, again, the tax treatment, intellectual property handling, and organization inherited within an LLC structure versus trying to make sure there's a clear separation of property. Finding investors is easier with an LLC because there's something to actually buy compared to changing a sole proprietorship into a partnership. Along the same lines, an LLC is more attractive, all else being equal, because investing in an LLC, again, limits investors' liability. Limiting contractual liability. Okay, technically, a loan and other contracts an LLC engages in with a personal guarantee creates contractual liability for both the LLC and you personally, albeit your LLC may have many other contracts not requiring a personal guarantee. For example, you start your LLC and rent a location for a year, and after 7 or 8 months, the business folds due to lack of sales. If you haven't personally guaranteed the rent payments, only the LLC is likely on the hook. So you should have basically 2 takeaways. The first is, in order to protect your personal assets, insurance really is the key. And by insurance, I mean business insurance. You should never expect your homeowners or personal auto insurance to protect you from liabilities deriving from business activities, unless coverage is added to a homeowner's policy for a home-based business, which many homeowners insurance policies will offer for an additional cost. Your homeowner's insurance policy almost certainly has an exclusion for business pursuits, which includes basically any income-producing activities, including working for another. The same is especially true for personal auto policies. Even delivering pizzas on a Friday night for extra income is typically excluded under a standard personal auto policy. And as crazy as this may sound, I've talked to people hauling travel trailers across the country for money thinking their standard personal auto policy was sufficient. They're often shocked when they find out the price for the correct coverage compared to personal auto. Another advantage of insurance is the legal defense benefit. If your business is sued, regardless if it's a sole proprietorship or LLC, for a covered negligent issue, contract-based suits may not be covered, you can count on your insurance company paying for your legal defense costs, at least up to the amount of liability your insurance policy is good for. For many, if not most business people who operate with reasonable care, this is truly the best part about having insurance. The second takeaway is knowing you want to fully appreciate and understand your operation from the context of profitability and liability exposure in order to make an informed decision if jumping through the LLC hoops is worthwhile. One of the most difficult questions I ask new business people when applying for commercial business insurance the first time is, what do they think their revenue will be? Even though it's a tough question, it's important because knowing your projected revenue is a required step towards calculating your projected income. If your business projected income, along with your personal physical activities, means you're not going to receive by much, if any, benefit from having an LLC, you should consider saving the added expense. I find this is most common when the profit is actually expected to be near zero, or the business is expected to produce a net loss for the first year. Lastly, talk with somebody who can appropriately guide and answer your specific situation questions so you're not playing a guessing game with your financial future. It's hard to go wrong surrounding yourself and your business with highly qualified professionals. If you look at your business and your situation and you determine that after consulting with a business attorney that an LLC doesn't make sense, you're really going to benefit from the added cost savings. Likewise, if you do decide an LLC is the most appropriate way to go, well, then you know that you've made a better and a more informed decision. Thank you very much.